Today, I'm buying these 4 dividend ETFs with zero NAV erosion. The markets are a little bit scary, and these are currently on sale. Now, I don't know what's going to happen if we are going to see more of a pullback, but I do believe in the long-term ability of these ETFs to not only produce income, but to accrue value as well, which is very hard to find in these high-yield ETF spaces. So I hope you guys do enjoy. If you're interested in ETFs and dividends, don't forget to subscribe. Let's get into the video. This is a newer fund, but it's definitely one I will be watching for the long term. So it's ticker TSPY or TSPY by Tap Alpha. And they're utilizing a different strategy than a lot of the other income ETFs where they use zero DTE calls. And that gives them a lot more flexibility and some more exposure to the underlying, which I think is really important if you're afraid of NAV erosion, which a lot of people are. So if you're interested in finding out more, I did do an interview with their CEO, which is Sai Katara. He's a phenomenal gentleman. I really like him. I've met him a couple times at some different events and whatnot. And he actually broke down these zero DTE strategies, which was really eye-opening and how they utilize them. And I'm going to be interviewing him again in just a couple of days. So if you guys are interested in dropping some questions down below, I would love to throw some stuff at him, maybe even some harder questions about performance and whatnot. But all in all, TSPY and TDAC have been doing pretty phenomenally. One really cool thing that he does as well with his funds is he staggers the distributions. So if you hold TSPY and TDAC or TDAQ, their NASDAQ ETF, you can actually get paid twice a month, but you're getting paid 2 weeks apart. One pays, I think, the first week and one pays the third week, just so you get kind of more income. It's the same amount of income, but it just feels a little different. You're not getting everything all at once. It's coming in a staggered rotation, which is really solid. It's got a 14.35% distribution rate, 150 million in net assets, and the total expense ratio is 0.77%. Not terrible. It's a little bit high, but it's, I can't complain because the fund has been performing really well. And I always say I'm fine with a higher expense ratio as long as the fund performs well. Hint, hint, some of these other issuers that are absolutely putting out insane funds with insane expense ratios that are absolutely falling. So one important thing to note, though, is TSPY is our S&P 500 ETF. And what we're going to do now is we're going to look at how it compares to SPY's price, because we have to check if this really is a no NAV erosion ETF. We have the SPDR S&P 500 ETF, or SPY, plugged in, and we're comparing it to TSPY. Now, as we scroll down, we'll see there's quite a disparity in in price return. This is not total return, so we're not including dividends yet. We can see TSPY is down 2.36% on the year, and SPY is up 13.42%. Now, what's really important is that this thing took quite a dip. TSPY specifically fell 20.5%, but since then has climbed quite nicely all the way up to nearly being positive, which is pretty amazing considering that this is a dividend ETF. When we go to our total return, we do see a very different story. Now, SPY does pay a small dividend as well, so we can see it's up 14.8%, and TSPY is about 2% behind it at 12.53%. And this is the cost that we pay when it comes to needing income, to needing those distributions. This is also not with drip turned on, which would actually make it a different story because you would have been buying more at these lower costs. But not factoring that in, this is still pretty solid. I think that TSPY does a really good job at following SPY's price. And the beauty of it is, like we saw, is after it got knocked down pretty hard, I personally believe that SPY will bounce back. Even if it were to fall 40%, I would be investing so heavily because I do think it will bounce back over time. And that is kind of something that TSPY has proven. So utilizing the zero DTE calls, you're able to get a high yield and you have a very solid underlying with the S&P 500. Now, their NASDAQ ETF is one I'm watching very, very closely. It's newer, ticker TDAQ again. That one I'm watching because the NASDAQ has higher implied volatility. So you can get a higher distribution rate, but I'm not sure how the total return will look. If it's anything like TSPY, I will definitely be making content on it. Next, we have ticker GPIQ. This is a NASDAQ 100 premium income ETF by Goldman Sachs. And I like this one a lot for a number of reasons. In reality, it's just very solid. They kind of built this thing in a slower growth, but also dividend yielding sort of way. So it kind of seeks two different audiences, those that want underlying growth and that want a nice dividend yield. Now, the yield is a little bit lower than some of the others. It's at 9.5%. but the growth is there as well. And for me, when it comes to these income producing ETFs, total return is everything. I like having a higher yield, but if you have NAV erosion, that just eliminates the entire purpose for me. And I do want to say really quickly that I've seen a couple other videos on no NAV erosion ETFs, similar to some that I've made, and that's fine. We're all in the YouTube space. If you see a no NAV erosion ETF video that has a YieldMax ETF on it, I would say be very careful. Now, I've made tons of content on YieldMax. I've talked about the risks of YieldMax, and I will say I was watching a video about some weekly payers, and they included what? HOOY, Hui, the YieldMax weekly paying ETF on Robinhood. And I will just say that the underlying is doing really well, and that's why it's no NAV erosion. So in my opinion, there's two different sets of no NAV erosion. You have quality no NAV erosion funds like GPIQ, like QQQI, like most of the funds by Neos, by Tap Alpha, and those will predominantly forever be no NAV erosion. When it comes to these YieldMax ETFs, they're only no NAV erosion now because the underlying is doing really, really well. And that's what it takes, right? Everyone once said that Misty was a no NAV erosion ETF. And what is it now? It's down big time. So just remember that, just be careful that single stock no NAV erosion funds are very risky, and they're really, really, it's all determined by the performance of the underlying. And so on and so forth. Now go back to GPIQ. So we can see this fund it's just a consistent payer. It really is. PE ratio, all that stuff. I don't care about that as much when it comes to these ETFs, but the expense ratio is key. And this one is 0.35%, which is very solid. It's cheaper than a lot of others, and you're getting that growth and the distributions. 106 holdings. And if we scroll down, they do some really interesting stuff where you can see if you had invested $10,000 at the inception date of October 24, 2023, so a little over 2 years ago, almost 3, you would see that you would be at $16,187.61, which is very specific, but they're showcasing the growth. And this is definitely including the distributions. If it's not, that would be super surprising. But still, a very solid return over a couple year period. You can also see since inception that they have underperformed the underlying. The NASDAQ 100 typically will outperform these. And I'm curious how it does in the next couple of months to next couple of years. If we do see a red market, it'd be interesting to see if this would shift, if GPIQ would begin to outperform the NASDAQ 100 because you're getting the distributions. And, if there's lackluster price performance from the NASDAQ 100, we should see GPIQ do better, as well as a lot of these income producing funds. So what I want to showcase now is the price chart. Let's compare it to the NASDAQ 100 and see if this really meets the criteria to being a no NAV erosion ETF. We have GPIQ and QQQ, the Invesco QQQ Trust ETF, which just matches the NASDAQ 100. Now we can see price return on the year, GPIQ trails by a lot. It is only up 8.24%, but QQQ is up 21.5%. And the reason GPIQ is up is not only because its underlying has done well, but because they have it formatted to be a no NAV erosion ETF. They want this to have growth as well as yield, which I think is absolutely phenomenal. Now, when we go to our total return, it's a completely different story. They're actually very close. And at a few points, GPIQ is almost doing better than QQQ, which is very, very interesting, especially on some of these downturns. So we can see GPIQ total return is 20.22% and QQQ is 22.14% when we include those dividends. So GPIQ is one that I'm really looking to add to my portfolio. I don't want to be too NASDAQ heavy because I do have a lot of NASDAQ in my portfolio currently, the NASDAQ 100. So there is kind of a mix, but if you're like a beginner ETF investor or a beginner dividend focused investor, I think GPIQ is definitely one to look at. As always, do your own research. This is not financial advice. And let's get into ETF number 3. I'm using BTCI because I want to showcase one very specific thing, and that is what really is NAV erosion. So when we look at BTCI, we can see it pays monthly. It has a 1% expense ratio. It's by Neos, one of my absolute favorite ETF issuers. And I mean, it's expensive to hold. The distribution rate is 28%, which is pretty wild. It is very, very high. But the fund has just been dropping like crazy. So if you haven't been watching, Bitcoin is falling pretty steadily. It fell from highs of 120,000 per coin down to in this 80s, which 84,000 I believe, and that wreaked havoc on all the Bitcoin producing ETFs. But is this NAV erosion? No, this is not. This is price drop. And something a lot of investors get confused with the term no NAV erosion is they think that the fund will only go up. And unfortunately, that's not the case. And I think most people do understand that. Most investors do understand that. But BTCI is not going down because of NAV erosion. It's going down because Bitcoin is dropping pretty quickly. So it was down 30% last time I checked. And that's why I do think it is a good time for me to invest. Not you. You need to make your own decisions on when you want to buy in, but doing a starter position on BTCI to begin tracking it, I think wouldn't be a bad thing. I do not think this is the end of the fall of Bitcoin. I think Bitcoin will continue to fall, and the cycle and all that, all the details that involve cryptocurrency kind of goes over my head most of the time, but I do think that BTCI at these prices would be solid for me for a long-term investment. So that's why it's on this list. And also, again, to showcase that a falling ETF doesn't necessarily have NAV erosion. NAV erosion comes from the amount they're paying out, and which is why we see companies like, YieldMax paying out huge amounts, and that creates the NAV erosion, which is a difficult thing to watch happen to your invested capital. So BTCI, solid fund by Neos, in my opinion. It's probably their highest risk, and it's probably the riskiest in this video series today, simply because Bitcoin is a high implied volatility asset. But I want to know your thoughts so far on these first three, or all total four. What is your favorite ETF in this video? And now we'll check out number 4. I think Amplify ETFs aren't spoken about enough because they have quite a few now. They're lower yielding than some of the competition. They're not yielding 50%, but they're very solid. And so we're talking about ticker QDVO, and I did a full video out about this one recently because it became the best performing monthly ETF with no NAV erosion because EGGY or EGGY took quite a fall when the market dropped. Now QDVO is kind of similar to GPIQ, different issuer, but it's growth and high income potential. And the basis of this is the way they're running their options, of course, but also more exposure to the underlying, where you're still a little bit capped on your growth. So compared to QQQ, it's going to underperform for the most part. But it is really interesting seeing how QDVO correlates to QQQ and GPIQ. Net assets is just under 500 million, and it has 47 holdings. The expense ratio is higher at 0.55%. But again, if they're performing well, if it's making me money, I am okay with that. Smaller number of holdings in the NASDAQ 100, which is why this one is a little bit riskier, I would say. The yield is roughly 10%, pays out monthly. Can't really complain about that by any means. And it's primarily large cap dividend growth stocks. So it's designed to offer those higher levels of total return on a risk-adjusted basis. But with fewer holdings and a lot of exposure to these QQQ holdings, I don't want to be over-invested into the NASDAQ 100, which is hard because the NASDAQ and the S&P, there's a lot of overlap between those two, so you have to find other ways to invest, and it just gets a little bit complicated. But all in all, that's what we're here for, right? I want to be diversified. If you know me, you know that I'm a mix. I'm a growth investor and a dividend-focused investor, but I don't use my dividends to live off of. What I like to do is I take the dividends and I put them into either the underlying that distributed them, so in this case, QDVO, I could reinvest it into that when it's at a low, or I could put it into a new position that I'm starting, like in a different ETF, in a different income ETF, a different growth ETF. And that for me is really fun. That's why I do enjoy investing, hence, a whole YouTube channel about it. So when we look at our returns, we can see price return wise, similar outlook to GPIQ. We have 8.81% for QDVO, and for QQQ, 21.48%. When we go to our total return, very, very consistent. We have QDVO at 20.84% and QQQ up 22.14%. And I'm going to explain this again. For those that don't know, we're capped on our upside for our income producing ETFs. And that's why they will almost always underperform the underlying, right? So the NASDAQ ETF, the growth ETF, is going to perform better than QDVO, than GPIQ, than QQQI, than TDAQ, simply because options do cap your upside to a certain extent. And even though they're very, very close, that's kind of the cost, the price that we pay for income. Now, with DRIP turned on, I think it's more than worth it to have the income side of things, but we do have to have no NAV erosion, which I think is very, very important. So I do hope you guys enjoyed this video on these 4 income ETFs with no NAV erosion. They pay monthly, and I really hope that you guys found it educational, informative, and overall entertaining. If you did, don't forget to like the video and to subscribe. Comment your favorite ticker of these four, and let me know if you're buying any of these anytime soon. Thank you guys so much. Hope to see you in the next video.